gentlemen, I'm going to show you the stocks that made me rich, that generated the vast majority of the gains in my portfolio, where I bought them, where I sold them, and where they currently sit today. And then we're going to take a look at those individual brokerage accounts, my largest accounts, to see the performance of where I currently sit in these tumultuous times against the S&P 500's return. And then we're going to take the nuanced strategic approach that I have in the stocks that I'm buying now and the stocks that generally interest me moving forward. But first and foremost, I need you to do one thing. Hit that like button, because I'm going to offer some solace to your soul with a guy that you might not even know existed. And most people don't know of this gentleman. His name is John C. Bogle. He is the inventor, the original gangster of the creator of indexed funds. You know, the Vanguard S&P 500 index fund, the thing most investment advisors, even the people on YouTube, Graham Stephan, are mostly advising people to buy. That the guy made this. And like I said, unfortunately, rest in peace your soul, good sir. He passed away a few years ago, but he didn't leave us, with no advice. This guy is a legend beyond means, only comparable to the likes of Warren Buffett. And I wanted to share this with you because it really resonates with how our chat groups feel and what I constantly preach. So take a listen. We'll be right back.
If the U.S. stock market suddenly went into an unexpected broad market decline of greater than 25% and still heading south, what would you tell us to help us stay the course?
Well, the first thing I'd say was, who the heck knows whether it's still heading south? It may have stopped going down at 25%, and a lot of them do stop in the 20-25% range. But, it's an opportunity to buy more, and certainly there are a lot of funny ways of, it's not very hard to give advice on these kind of things. But the one piece of advice I would categorically give to everybody, for God's sake, don't stop a program of regular investing because the market goes down. You're killing the whole value of dollar cost averaging, and it may go down for a few more years. Who really knows? But so much the better when you're putting money in every month, because it will come back.
One rule of thumb: always be buying, especially if 20 or 30-year time horizon ahead of you guys. This is an opportunity of a lifetime. So let's talk about the opportunities of a lifetime that propelled my accounts over the last several years to get me to where I am today. With numero uno, the first stock I ever bought, if you can believe that, is Canopy Growth Corp. This stock is blowing my mind. My first account was kind of conceived back in 2014, and I bought two stocks, this being one of them. And basically, I was kind of speculating on the idea of legalization and the hype that would bring. And in 2018, sure enough, it paid off. And this stock just jumped dramatically, at which I was selling it in the mid-20s range to only watch it go all the way up to $67 a share. I did not have the guts to buy back into it, thought it was relatively overvalued, took those gains and moved elsewhere to only watch this thing collapse 94% back down to the very price I was originally buying at it. You have to understand the risk when you're buying individual stocks. As much as you can love them, do not get married to them. And in a short period of time, if you make 100% of gains, don't be an idiot and take some off the table. Let's talk about Apple real quick. This one came as a bit of a shock to me because obviously when I looked at this like several years back, or at least I think 5 or 6 years ago, I realized that, it's the largest company in the S&P 500. So every time someone buys an index fund, a good portion of it goes into Apple, and it's been the S&P top 10 number one company for a very long time, right? So this thing has offered me, I can't remember exactly when I first started picking up shares, but sometime back 2015, 2016 timeframe, this thing was giving me hundreds of percent of return, and is probably the second stock that I bought in comparable growth to Canopy in that time frame. But putting Apple aside, Tesla should be mentioned here as well, because when I show you the individual brokerage account I bought Tesla in, this thing has led me to insane performance gains. I mean, take a look at this, because I was buying this in 2019 here, guys, and I did sell it. I took some losses on this one actually in my corporate account, but luckily I haven't lost any substantial gains on this. But I currently have no position in this because, again, the stock ran so absurdly. I've done nothing but take profits out of it. And like I said, I'll talk about some of my investment strategies moving forward, because I still have exposure to these, just not on an individual stock basis. But finally, the next best stock, the one that was one of the biggest unicorns for me, obviously having to be the psychedelic sector with MindMed, right? Now, MindMed, again, another one of these companies that has really returned back down to a baseline closer to where I was buying it at. I don't think I have to break this one down too much. For those of you that are OG to this channel, you might remember this stock for me being that lottery ticket that I dumped $7,000 into, later making like 40 or 50 grand. And a few other people I knew that bought into this around the same time made $500,000 plus. And luckily finally, they did take the advice of take profits, time to diversify. And again, all of that is paid out massively into our favor. So let's take a look at these accounts where I held these stocks and what they did. First and foremost, my tax-free savings account. This is my largest account by dollar value. It's currently worth about $140,000-$150,000. And obviously, as I've been kind of mix managing, trying to figure out what I'm doing in these tumultuous times, I have seen a bit of a heavier decline in the S&P 500 because of the individual holdings that initially were in here, but it's still up from the inception date of June 2017, about 131% against the S&P 500 that is only up about 57% in the same time frame. Now, my managed account, this is where I was holding MindMed, some of those other companies. Right now, I do hold individual stocks in here like RioCan, so it's no surprise that the performance to the downside is a little bit more graphic, going from a peak of about a 410% return down to about 284% where it sits today against the S&P 500 that is only up 88% in the comparable time frame. And again, this is my OG account. This is where I was buying Canopy Growth Corp back in the day, September of 2014, the day that I started investing. And you can see, again, I always tell you guys this, for those of you that might be new to the market, back in this time, my portfolio dropped 41.25%. And I didn't see green ever in my investing career for the first year and a half, guys. So, I mean, if you bought in the last 2 years and you're down on your investments, just remember it's never that easy. And this is a long game. But if you stick with it, you could potentially see things like this, right? Now, finally, where I held my Tesla. Now, Tesla, oh my God, this was a saving grace for tax-free perpetuated gains in this RRSP, or Registered Retirement Savings Plan, because I only started this account in August of 2019. And to date, even in this crazy market, it is up 224% in just a short under 3-year period against the S&P 500 that is only up 27%. These gains make the S&P 500 look like a joke, and this comes back to the same iteration of when you make hundreds of percents of gains in very short periods of time, always take profit, diversify, buy safer assets. And that is what's propelled all of my accounts to currently being worth combined about $330,000 without excluding kind of the cash position, not taking a look at the Bitcoin position, which obviously I'd be down 50% on, but they're so incremental that I don't take on that much risk with the much more volatile investments, right? Now, I'm not showing you my corporate account, which I think largely would be down, I imagine 15 or 20%, but because that account is still not some of my largest positions, I'll probably talk about that once I get corporate taxes done, and I'll kind of bring that up in a later video. But let's talk about my strategies now, what I'm buying at this scale. I'm not looking to make the same kind of returns that I was in the past. When you're younger, this was in my earlier 20s, you can take on more risk. You can kind of, try and find gains that'll lead this in your portfolio. But now I just kind of want more moderate returns. So I am buying the classic S&P 500 index from Vanguard, of course, a VOO. I've got over 100,000 in this currently, and this is going to become a staple to my cost averaging plan, along with these few other indexes I want to talk about, like VYM. Really like these dividend income ETFs because they're kind of taking the management out. Again, I don't want to have to look at 40 or 50 stocks, because if you're buying them on an individual basis, you really have to make sure you keep up on them, because of the underlying fundamental shift, it really only takes a handful of bad companies to really pull back your gains. I mean, just think if you bought Netflix, PayPal, Alibaba, Facebook, all those kind of companies, and you thought they were great discounted companies, to only see them drop another 50%, you'd probably be devastated, right? So there's always risk with individual stocks, but these companies and these ETFs kind of auto-weight them off their market cap. They take a lot of the management out and offer a lot of protection to the downside just for income. I don't really care what the actual stock price does. I'm more kind of focused on the income for these, whereas with the S&P 500, I'm more focused on total return. And in correlation, I'm thinking about adding the Schwab US dividend equity ETF here as well. I think I've got about 100,000 in VYM. I'm not sure if I want to divvy it up into this ETF as well, just to get a little more diversification, because they are very proponently different on their top 10 weighted holdings. But both of these ETFs offer around a 3% dividend, very reliable, very safe stocks, along with VDY, the Canadian Vanguard high dividend yield ETF, which this one is well over 3%. This one's getting closer to a 4% yield. These ETFs are what I'm primarily going to start shoveling most of my new money into, but I'm not adverse to risk because I still want to get some outsized gains, but I'm very careful about how I allocate money to these specific high risk investments like Bitcoin. Very controversial. I know a lot of people are picking on it, thinking it's going to go much lower. I don't know if it goes higher or lower, but I am still buying Bitcoin here to an incremental amount. Currently, I think I have about $3,000 or 4,000 in crypto, but I'm looking to just really carefully maybe add a couple extra $100 a month to this position. Now, from an individual stock basis, for an income perspective, as you can tell at the scale of my portfolio, I really like the idea of income, kind of using it as a backup emergency fund. So I still have my REITs. I still hold my RioCan, which I arguably think is at a better buying opportunity here now, trading down 23% from its highs. Smart Centers, I'm looking to add one more REIT, and I'm going to kind of take the dividends and keep reinvesting them. And I've been really contemplating Northwest Health Properties. I used to hold a medical properties trust, as what it's called in the US. The ticker symbol is MPW, and that's kind of like the US counterparted to what this REIT is in Canada. And I kind of sold it, luckily, at a good time because it dropped miserably. But I can buy this Canadian REIT, save myself the foreign withholding tax, and get a lot of stability and a 6.5% starting yield. I'm still playing around with the idea of this, but I'm looking to just add one more REIT, kind of rip it off like a band-aid, try and get 10,000 in here, and then just use that money as kind of a collective cash flow that if I want, I can tap into it today. Now, from a higher risk standpoint, there are two companies I've kind of narrowed it down to when I get comfortable with the market, perhaps finding a bottom. I think we're starting to see the end of inflation, and when we start seeing the bounce back, I'm primarily looking at actually adding the TQQQ to a very incremental amount, similar to like my Bitcoin position, where I might throw a few $1,000s in this. This is a triple leveraged QQQ ETF. If you guys don't know the Qs, they basically hold the top weighted tech companies like your Apples, your Microsofts, your Nvidias, your Teslas, and things like that, which currently I'm underweighted. But I think this would be a fun way to play back the return once the bear market sediment ends, because again, for every 1% this goes up, you get 3%. But obviously to the inverse side, it's down 71% because of how bad the NASDAQ has been performing, which is basically what the QQQ represents, the NASDAQ 100, right? But finally, just to diversify my portfolio where I'm lacking, which is in global diversification, I really like the idea still of Alibaba, which I bought, which I've sold. I've sold. But I still think it's probably one of the best buying opportunities for me, maybe not for you, not financial advice, obviously, but I do not have a lot of foreign exposure. And I think a pure play into the Chinese market, which obviously Charlie Munger spoke highly about, Ray Dalio. So I think this would be a very good add-on, which again, in the mix of me messing around with my accounts, this is kind of just where the cards have fallen. And like I said, I'm still really kind of hooked up on this, even though we're starting to see it kind of bounce back here. I still think it's a good price down here. But it's just a matter of me coming up with the cash to buy it, which I'll let you guys know when I actually pull the plug on this. But on that note, folks, that's where I currently sit, and I want to pass the question off to you. What do you guys think about all this? What is your strategy? What are your best stocks, your worst stocks, and where do you sit today with them? I'd love to hear about all of that in the comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.